that while the market has this long-term upward bias, well, every 3 or 4 years, you're probably bound to get some kind of reset, right? That's what a
Hmm.
correction in a bear market is. It just so happens to be when I was so interested in both sports and covering the stock market in the 90s that those two things aligned at the same time. And then when I joined IBD in 99 and got to know more about the IBD methodology and really looking at a lot of charts together with folks like Justin and Arusha and Chris Kessel and Bill O'Neill and other in-house money managers who work for Bill, you know, we came to understand that yes, uh, history doesn't obviously repeat itself perfectly, but it does rhyme, and you generally have these cycles where you're going up 2 3 years, and then you have a down year to sort of get rid of that speculative froth and let stocks reset, let new IPOs come to the foray, and let new leaders come in. So I think it's very important for the long term to understand that the market really hasn't changed in that way. We have these cycles. We should respect them, and it and rely on that as something that will continue rather than, oh, okay, the NFC Super Bowl team won,
Right.
the AFC Super Bowl team won, or as a World Cup event. And before I forget, one thing also I wanted to add about the Super Bowl indicator, isn't it funny that the New York Times writer Leonard Koppett noted that yes, NFC team wins, we're going to have a stock market, a good winning stock market, right? Well, what if it was the AFC team that won and the market was up 82% of the time? I think it really doesn't really matter because the truth of the matter is, it's the stock market does tend to go up most of the time. You know,
Mhm.
82% of the time, that sounds about right. So it's just like kind of putting two kind of coincidental things together into one, and whether there's any causation or not, well, it's fun to talk about.
Yeah. Well, and it's also one of these things where, as humans, we tend to look for patterns, right?
Yeah,
And so
right.
there is this kind of bias that we have looking for meaning sometimes when there isn't. Because again, who who could make a causation relationship between the football team and the market? But Jeffrey Hirsch, of course, he's been on a number of times from the Stock Traders Almanac, and the presidential cycle. There is certainly data that supports a tendency for action
Hmm.
based on the presidential cycle and seasonality in terms of months and where you're at in that presidential cycle. So um, I guess the end result is um, there's a lot of things that people can look at, a lot of patterns that they can find, and there's those patterns that have maybe withstood the test of time, and those that are okay. You have a sample size of four, and maybe that's not enough to really uh, to really build a pattern off of. But at the end of the day, David, what is it that investors should look at the most?
I take the cue from Bill O'Neill, especially in his book How to Make Money in Stocks. If you want to learn about fish, look at fish, watch fish,
Mhm.
examine fish, right? If you really want to know the stock market, really examine what the stock market is really doing, and those are the facts. And our producer on the show is making another good point. It's like, you know, he's talking about correlation is not the same as causation. I completely agree with that. Causations, there are certain causes, for certain moves in the market, and we have to, you know, really try to understand it as quickly as we can when the market is making a big move. But I try to really keep it simple, and I think both of you guys do the same. We
Mhm.
we look at the major averages. We look for any change in trend. We uh, we look for other signals that the market has more fuel in the tank in the form of good stocks breaking out of bases, making new highs, pulling back in lighter volume, sector rotation into um, stronger hands in the market, so to speak. And right now, if we fast forward to today, we're seeing relative weakness in staples and utilities, banks, and more dynamic industry groups, consumer spending, uh, tech, med tech, and to some degree, certain new home construction uh, areas doing much better. So we have to follow strength. I think that's really important.
Excellent.
Yeah, there
Well,
used to be
oh, go ahead.
there used to be a saying that would hold true, I think, in sports. I don't know if it necessarily holds true anymore, unfortunately, but defense wins championships, right?
Hmm.
In soccer, I still think that. I don't know if necessarily in football that applies anymore, but I still think in investing that is a huge key. Manage your risk, live to play another day, survive, because even though, as we saw with these World Cups, they come every 4 years, you can get some pretty devastating corrections that if you are not managing a risk, even though they don't come around that often, they can wipe you out. And so you have to always have enough money, have enough principal to live to play another day.
Hmm. And
Absolutely.
minimizing those drawdowns,
Yep.
that's how you get the compounding effect. If
Hmm.
if you get too big of a drawdown, guess what? It's tough to compound off of negative negative drawdowns. So yeah.
I feel like that those two comments could be the kernel for another future podcast because the defensive side of the investing game is ultra important. I agree, and then also, as Justin you mentioned, managing your risk so that you don't come too far off your the peak in your portfolio.
Hmm.
That's something that I'm really paying close attention within my own investing.